So last week we talked about dividends and dividend history, and it's where we've gotten to here. In the last 3 months or so, when we've been doing this, we've talked about valuations. We've talked about the financial metrics that we use. We've talked about not so much the makeup or the breakdown of a company, which is really where I want to go with this week. Just like I did last week, the dividend history was always important to me for stability. Okay, when I start to look fundamentally speaking, and I'm going to go to our old standby here. When I look at a stock, I want to know, is this something I can hold for a certain length of time? The Warren Buffett motto, right? If he's not willing to hold a stock for at least 10 years, he doesn't buy it, right? He's not interested. I kind of, bleed into that same kind of philosophy, if you will. And it's done me very well for the 20 plus years, that I've been investing. Okay. Not necessarily trading, but definitely investing. The fundamental concepts are like I broke them down. You've got stability, you've got metrics, and you got valuation. Those are kind of the three that I break it down to, fundamentally speaking. So last week when we talked about dividend history, we talked about not only the yield of something, how much are we getting paid, it's about how long have we gotten paid, have they been increasing that payment, are they rewarding us for being a shareholder? All these things are very, very important because they tell us how well a company's doing over time. So it's not just about a single number, it's about a trend. Our job as traders is to look at trends and look at pivots and all these other things. It's all broken down in the fundamentals when you start looking at it, say, okay, if I've got company A that has an increasing dividend and has done that for many, many years versus B, I have a company that has a decreasing dividend for even a few years. Those two are very fundamentally different companies. Now, you may not always be looking for that. We talked about last week as well, the difference between growth and cash flow. With these things that I'm talking right now, we're more looking for cash flow as opposed to growth. Growth has different fundamental metrics. We've talked about a few of those. We'll continue to talk about those as we go forward here, because there always is two different worlds, and they collide. Don't get me wrong, two different worlds when it comes to fundamental analysis. You've got your growth side and you've got your cash flow side, but the dividend history comes down to the cash flow side and the stability. Well, now this week I want to talk about what's called a shareholder payout ratio, or you could call it a dividend payout ratio. Okay. The reason why this is important, again, is because it's a measure of stability. Okay. It's going to tell us if a company can sustain paying those dividends that we've looked at. So last week, when we looked at a Coca-Cola, perhaps, let's pull that up there because I had just so happen to have this one on tap here. We look at a Coca-Cola here, and we see here that we've got 59 years
of consecutive.
Yeah.
Are you want me to share or do you want to share?
Oh, I'm sorry.
Yeah, I dropped screen about 2 minutes ago.
Sorry, I thought you guys could see it.
You've been looking fantastic, though, I can tell you.
I thought you guys could see it. Thank you for that, Matt. Appreciate it.
Yeah.
All right, so hopefully you guys can see this now. I feel like such a heel.
No. You're awesome, my friend. Can see it perfect.
Okay, great. So as I was saying, we look at a Coca-Cola here. They got 59 years in a row where they've increased our dividends. That shows you a stability. Now the question it becomes is can they continue that into the future? We want to know, and it's not just Coca-Cola. You can look at any company for this, but I use this as an example because it's one of my favorites. But you need to know, can this company sustain that long term? Because if they can't, if they're running into problems, you want to know that before it becomes a problem for you, or before there's a dividend cut like a GE or things like that. We want to know that in advance, and this is one of the ways we can do that is by looking at the payout ratio. So again, it's sustainability of a dividend. Okay, can Coca-Cola continue to pay for 60 years, 65 years, so on and so forth? So we look at something called the dividend payout ratio here. Right here, it's 83%. So to come up with this metric, all we do is we take the number of the amount of dividends paid and we divide it by the net income. Okay, at the end of the day, that gives us a percentage, and that's what this percentage means. 83% of all the earnings or net income of Coca-Cola is paid back to their shareholders in the form of a dividend. Okay, if you have this at like 400%, okay, let's throw in Exxon. I don't know what how high theirs is still here now, but it was quite high for a while there. There you go, 446% for ExxonMobil. Okay, if you see something like this, what that means essentially is that the company is now taking cash out of their, out of the balance sheet, cash out of their pocket, and they're paying these dividends. Okay, this is typically a red flag, and I'm going to address Exxon specifically in a minute. But this could be a red flag, and it's something that we have to pay attention to. Okay. But if we go back to Coca-Cola here, again, there's other places to find this data, by the way. Finviz is one of our favorites here. Nice little free website. If you go to Finviz, you'll see something here that says payout. This is dividend payout ratios trailing 12 months. And it gives us about 81.2% there. So very close to that 83. So lots of different places you can get this information. Okay. There's two ways that this can be, this metric or this ratio can be used: safety and comparisons. Let's talk about safety first. Okay. Obviously, we just kind of did an example there of a high payout ratio could be a red flag. It could be, potentially a company, their earnings have fallen off, right? Or their dividends increased too much and it's outpacing their profitability. Okay. If that's the case, we definitely want to know that. So there's a definite, need for us, fundamentally speaking, to keep an eye on this payout ratio, because the only way this payout ratio changes is one of two ways: increase in earnings or decrease in dividend. That's it. Those are the two. Decrease in dividends is not necessarily a fundamentally sound practice. Not always, but most of the time. And increase in earnings, that's a good thing. And we've talked about earnings per share as well. So anyway, that's your safety part of it. That tells us if a company is good. Now let's talk about comparing companies. So let's say we're looking at buying a particular company. Okay. And so we go and we say, okay, well, what's the dividend? And we go and we look at the yield here. The yield here is 2.76%. Okay. And then we go look at the payout ratio and we say, okay, it's about 81% here. Well, if we went to another similar company, and I don't know how these numbers are going to work out because I didn't look at it, but it should give us some insight here. Maybe we're looking at buying another company, and all things being equal, similar companies, similar, let's consider everything being equal. Well, we can look at it and say, well, they're paying about 2.4%, 7%, not as much, but close. But their payout ratio is considerably lower. Okay, so now this gives us an ability to compare, apples to apples and say, hey, maybe I want to buy company A versus company B. So these are two different ways that we can use this dividend payout ratio. Now, the caveat with things like ExxonMobil or basically commodity-based businesses, okay, commodity-based businesses tend to have, not always, but tend to have dividend payouts that are a bit more sporadic, right? It's kind of feast or famine. This probably goes a little bit more to gold stocks necessarily than gold and metal stocks, more so than Exxon, because their business is more inclusive, more broader, if you will. But when you start to see things that have energy companies and metals and mining, things like that, you're going to have a more sporadic dividend payout, and that is going to affect this payout ratio. So if you run into that, this is where you're going to need to start comparing similar companies of a similar nature to see how those numbers pan out. Okay, so just keep that in mind. Certain sectors like utility stocks and other cash flowing type stocks, they're going to have more steady, typically they're going to have more steady dividend payouts. So you're going to be able to look at this payout ratio and get a better idea of whether it could be an issue from a safety perspective, or whether you could compare it to something else. And then maybe that is one of the factors you look at in picking up one of these companies. Okay. So at the end of the day, the dividend payout ratio is, the way we look at it is we look and see if it's trending. Okay. So right now with ExxonMobil being so high, okay, if we looked at some of the other companies in this space, they also have some high numbers. Like if we look at Chevron, okay, now some of this data is messed up because of 2020, that's fine. But the dividend payout ratio, everything that Chevron makes right now is being paid out in dividends and then some. right? So this means they're using cash to do that. Well, these companies have lots of cash on the balance sheet. We've talked about that as well. So you can go and see those kinds of things. If you start to see a utility type stock where, their dividend payout ratio has been very, quite similar for a long time, and then all of a sudden there's a spike in it or a drop in it, that tells you that something has changed. And that's where you can start to do a deeper dive into that company to make sure that they're not running into a problem. An example, GE for the longest time was a really healthy dividend payer. Okay. And a while back, so their dividend payout ratio is 19% now. It got well over 100, and that's where they cut their dividend. They don't even show it anymore on this particular metric, but they cut their dividend a number of years ago. You could actually see that in the dividend payout ratio as it went along, as it trended. So this is a very good tool for keeping tabs on your fundamental stocks. And if they start to get into trouble, this is where you can make a decision whether it's something you continue to hold or you hedge, or maybe you're okay with the dividend. Maybe you're okay with the dividend cut if the dividend happens to be exceedingly high and it gets cut in half, kind of like an AT&T. Maybe it's still something that you're willing to hold on to, but at least you're making those informed decisions. So with this week's tool, Fundamental Focus, the dividend payout ratio is something that we have to pay very close attention to, not only when you start to get in, buy into a stock, but on an ongoing basis as well.
Love it, Coach Greg. Thank you so much for another edition of Fundamental Focus. This has been very entertaining here today and informative. Mark, Greg, final thoughts to you, my friends.
Yeah, listen, it's a messy, we have the unemployment report tomorrow, right? We saw the Fed's minutes create chaos, who knows, like maybe unemployment report comes in not as bad as expected, causing Fed to speculation the Fed won't do jack and squat and you have a huge rally, or maybe it comes in smoking hot. I don't know, right? Who knows what the market reaction, but we got another event tomorrow with the unemployment report, can cause fireworks to the bull or the bear side. So be aware of that. And just be aware the major theme in this market right now. I know I'm accepting less credit on boring companies like Discovery Communication or American Sports, couple of Tackle 25 stocks that I particularly like. Waiting for volatility in Bitcoin and the underbelly and all that to play itself out. And, maybe accept some less credit or some nice things. I like Campbell Soup's breakouts today. The boring areas, they're working. I like what's working.
Awesome. Thank you, Mark. Coach Greg, final thoughts, brother.
Yeah. So one of the things that I noticed, and this is something I try to instill in the students that I work with, is when you have things like the Fed, we always kind of do our weekly routine on Monday where we kind of look through, the economic events that are coming out. When you have something like the Fed, it's always good to kind of, really be aware of when that's happening. And we saw that really, really, importantly yesterday, the Fed meeting minutes, which don't always mean that much. All of a sudden we saw the market get kind of beat up here. So if you know that something like this is coming along, and you should, that I think gives you an opportunity to kind of review your positions very quickly before these kinds of events and say, okay, are my stop losses in place? How's my trade plan looking for each individual thing? I think being prepared for these kinds of things, even if they're not, even if they're a non-event, I think is a wise idea. And it's something that I've tried to, incorporate more and more when we know these events are coming. These are not surprises. I think it gives us an opportunity to trim things, and especially when we start to see this increased volatility.